Please join me in welcoming Jonathan Miller.
Thank you so much, Ben. I really appreciate it. And welcome to everybody tuning in. Essentially, what the goal here is to give you sort of ideas about what to talk about like when you're pitching a listing, what's your take on the housing market. For the record, my crystal ball is held together with duct tape. So I don't want to, you know, give the impression that everybody should be able to accurately predict the future. It's more about presenting ideas and how to help your clients navigate them. The uncertainty of where we're going, and try to make them understand a little bit more, and that hopefully enables them to make a decision about buying or selling a home. Uh, a couple of things. If you haven't noticed, we just had a federal presidential election. And I did a study for the New York Times about a month ago, and I've actually done one before where I looked at a bunch of housing markets in the US. My firm, while we're an appraisal firm based in the New York metro area, I'm certainly nowhere near as competent as Ryan Lundquist is. You're a well-known appraiser in the Sacramento region. But I analyzed about 50 housing markets in the U.S., and it's really fascinating to see over the last. I've been doing this, for 30 years, and what I did is I looked at a bunch of markets. I looked at markets in California and Florida, in New York City Metro, and looked at transactions, looked at and the sales activity was analyzed going back 25 years. But what we did is we looked at even versus odd years, an even year being a presidential or a midterm federal election year, and an odd year being the years in between. And what we found is in a presidential election year, of which obviously we just went through, um, we tend to see a slowdown in activity, irregardless of the economy. Just that consumers have a layer of considerations that they have to go through and process in their head. And one of them is, what is next year going to be like with the same president or a new president? And so what do? They tend to pause. They pause. And what we found is it's not as much as you would think, but the pause or the slowdown in activity, there's a restraint of about 5%, sort of low single digit, where from starting usually in July and ending up through November, we tend to see a slowdown. And then meaning that it's not that sales necessarily are they're when I say 5%, I'm really referring to the idea that sales are off from whatever they would have done if this wasn't an election year. And then what we see right after the election is we see a pop. We see a return or a normalization of sales, sort of a catch-up period, beginning from the day after the election through the early spring. And then we're sort of caught up again, and the odd year is, from the context of the election, we see a little bit more activity. So when we think of 2025, and by the way, and I'm going to talk about the rate cuts and what's going on with mortgage rates beyond just the numbers. But the idea here is that there is now one level of uncertainty removed from buyers, and I think that's important. And uh, 8 out of the last 11 federal elections, rates were actually cut. We saw the rate cut in mid-September. Um, this is not new or a new concept. This is pretty common. That's what we tend to see. Um, and we then see a release into 2025. So just at the bare minimum, uh, no black swan event like another COVID, just sort of what we have to deal with right now. It is a reasonable expectation just to think that we're going to have more sales in 2025. However, it's I'm not characterizing this as some sort of boom or frenzy. And for obvious reasons, when we talk about mortgage rates in a minute, but I do expect it to be better than what we experienced in 2024, and better in the context of more transactions. One of the things that you can be sure is that consumers are very confused about the mortgage rate picture, and um, the sort of back in August, before the Fed was even talking about doing a big rate cut, there was an expectation that there would be very little rate cuts going on in the future. And it didn't, and it almost, we were sort of concerned about maybe hitting a recession, which would be a concern. The thing to the reason why a recession is something in the housing market we don't want, I think a lot of people hear the word recession and they become very, it's sort of the boogeyman. It's like we don't really understand it, but it's a negative economic event. Really, when you think about the word recession, you should think about job loss. And so while recessions usually bring lower mortgage rates, it also brings job loss. And last time I checked, maybe other than during the go-go years leading up to the global financial crisis, where you just needed a pulse or to be able to fog a mirror to qualify for a mortgage. Banks are very diligent these days. No one's lost their minds, which means even in a weaker economy, which we're kind of going into, banks aren't going to be the problem. They're not going to be this sort of variable. I think the variable for us to all be most aware of going forward into 2025 is the threat of inflation. And when you think about the primary reason for that concern or threat is because the centerpiece of the incoming administration's economic policy are tariffs. And tariffs are highly inflationary. When you add 10 to 60% to each of the items being imported, that does create inflationary pressures, which would essentially keep mortgage rates from falling. In addition to that, there's a lot of talk about tax cuts, which also is inflationary. So, if we were having this conversation 3 or 4 months ago, we'd be thinking, wow, rates are going to be a lot lower in 2025, and that's going to really bring or cause an uptick in sales. I still think we're going to have an uptick in sales, and I will explain that further on. But in the context of seeing much lower rates, the 30-year fix today, Freddie Mac just announced an hour ago that essentially the rates stopped rising, sort of leveled off, and the 30-year fix is now 6.78 for Freddie Mac. It was almost touching 6% a few months ago, but we had rates actually rise after the 50 basis point Fed cut in the middle of September. So, which brings me to why did mortgage rates go up when we had a 50 basis point cut? And in fact, last in September when that was happening, there was a conventional wisdom that we're going to have another 50 basis point cut in November. We ended up having a 25 basis point or a quarter of a point cut. So now the question is, what are the future cuts going to be? And if you think about it, we have another Fed meeting in December, and then there were talk of a couple more 25 basis point cuts in January and February. We don't know. The idea here is that even if we have those cuts, we're probably not going to see mortgage rates. I would be surprised if they fall below 6% from where they are now. But any kind of cut is probably going to result in higher rates. One of the interesting things about the Sacramento market, just in general, is that even with mortgage rates rising um, over the last 6 weeks or so since the last Fed cut, is that we're essentially seeing, and this is what I'm seeing nationally, is we're seeing sort of sales, contract activity either rise or move sideways. Um, and so I think the way to think about this in the going forward in lieu of significantly falling rates is the tried and true concept of time. In other words, if a consumer was just ready to buy a home 2.5 years ago when the Fed pivoted in early 22 to the steepest ascent of rates in history. So that the early 22 to late 23 sort of Fed window of trying to influence rates higher to cool off the economy, cool off inflation, which was very successful. But to do it, they raised rates faster than they ever have, meaning in the context of a short period of time in history. So what does that do to the sales market, right? It clearly slowed sales nationwide. I mean, what's happening um, in most housing markets around the world is that sales are down 10 to 20% from sort of long-term established stabilized levels. And the key reason for that has been the rise in interest rates, a reduction of affordability. But what is continuing to confuse sellers and buyers is that we're not seeing much in the way of discounted prices. So if, a couple of years ago I was having a conversation with anybody on this call, and they were saying, "Hey, mortgage rates are going to rise 2 to 3 times what they were in just two years, and housing prices aren't going to change all that much. If anything, they're going to rise." It would be a very confusing conversation. It would be for me as well, because when you think about a normal transaction situation, you're in a market where rates rise, and what happens first? Sales slow. That's what happened here. Sales slowed, and so what happens when sales slow? Typically, inventory surges. That did not happen. And so the reason for that, and when inventory surges because of lower sales, you get new price discovery. Like, you have more competition, listing prices come down, or sellers are more negotiable. But we haven't seen that. The reason we haven't seen that is because of the Fed pushing interest rates very hard to slow down the economy to prevent us from going into recession, which would be very, very not very good for housing. And we've avoided that. And we're not seeing, any issues in the banking industry. So it's really the reason for that is the lock-in effect, which I might even have mentioned on a prior call. This has been something that's been going on for the last 2.5 years, where someone that has enjoys a 3% mortgage, um, and the current rate is 7, why would they sell, right? And that is why sales are lower. It's as simple as that. There's no, the election is very modest. I was saying about 5% slowdown in sales. Um, it's really the idea of people are locked into the rates. And um, there's something that I call seller resolve and buyer resolve. It's this idea that, sellers for the last 2.5 years have been losing their resolve. Their resolve is to not sell and wait till mortgage rates come down. Well, they've been waiting for 2.5 years. If they were about ready to buy in early 22 when the Fed pivoted to this higher rate stance. What are they going to do? When what we're seeing is rising inventory means the seller sort of position, the seller resolve to stay put is weakening. That more list inventory coming into the market should enable more sales activity. And buyer resolve is sort of the same idea. They're waiting for rates to come down, and we just had a 50 basis point rate cut, and mortgage rates went up about 50 basis points, a little bit more, from just almost touching 6 to almost touching 7. Ultimately, I think when the dust settles on all this distortion coming out of the pandemic, I think mortgage rates long term are probably going to sit in the 5.5% to 6% range. I was saying that during the pandemic itself, when the Fed basically kept rates too low for too long. And we're sort of paying the price for that as a market. The rates were held too low for too long, and existing inventory was obliterated, wiped off the face of the earth, if I want to be a little dramatic. Um, the idea here is that uh, uh, that with inventory, the only way for a lot more inventory to come into the market, a lot more, is for some sort of economic slowdown. But people have record home equity, so they're not under financial distress like they were back in 2011 or 12 coming out of the financial crisis. There just isn't the sense of urgency. I know you see that in sales, like people don't have necessarily the same sense of urgency that they have had in prior cycles. So it's sort of a wait and see kind of market. Um, I look at um, so when you look at 2025, we look at when I was asked to talk about a couple of years ago for someone in New York in 2023, I was describing the market as when they said, "What's going to happen in 2023?" I said, and this is when mortgage rates are right in there. We were in the middle of the surge in rates. I said 2023 was going to be the year of disappointment because we weren't going to see the sales activity that we'd seen in 22. In 2024, I'm calling the year of less disappointment because sales in many markets were a little bit better than 2023, but nothing, to write home about, essentially. I think 2024 is going to be, um, uh, it's not that it's disappointing, it's just going to be sort of boring. I'm not expecting a boom in sales, but I'm expecting more sales than we had in 2024. And the reason for that is time, that we've been waiting, you've been waiting um, uh, for 2.5 years for um, for more activity to occur. And I think we will, but it's not because of falling rates. It's going to be because of people, their resolve is weakening, that they want to be their life changes, right? My example, they had triplets and they need more space. There's only so long they're going to be willing to wait, especially if they can afford it, given the strength of the economy with very low unemployment and wages are still higher than they were pre-pandemic, adjusted for inflation. The
Jonathan,
other, Yeah,
Can I bust in here for a second? Because we talked about
sure.
answering questions along the way. So I do have a couple that I think are pertinent
Okay,
to
go
what we
ahead.
were talking about. One comes from Michelle, and she asks, "Will prices continue to rise with buyers holding back?"
Yeah, so the answer is yes. I think it is because inventory has not normalized. Inventory has clearly risen a bunch, for example, in the Sacramento area and California in general, and the US in general, but it's coming off of record lows or near record lows. So the current levels in the Sacramento region are still only about 40% of the levels seen during the sort of the high watermark set in during the housing bubble. Um, there's still I still think the market is not normalized. It's still uh, tighter than it normally would be because inventory has not normalized. Is the way I think of it. And that just keeps pressure on prices. The other thing is, and this is maybe more of a white paper sort of analysis, is that work from home and the proliferation of work from home has actually made housing prices higher. And the reason for that is people are more willing to live in a better location if they can afford it because the commute is not as much of an issue. And so that's sort of a national phenomenon that has been written about quite a bit by economists. But that's the idea.
And here's another. I got two more questions, then
Sure.
then you can proceed. Here's another question that's submitted by Anonymous. What will the cost of insurance do to inventory and prices? Because that's a
Okay.
great question as well.
Right. 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 So, and I think I heard you saying earlier that Manhattan, where I'm speaking, where our offices are, we actually have a wildfire in northern Manhattan right now. Who would have thought? I thought California had the corner on wildfires. But when you think about insurance costs, homeowners insurance, disaster insurance, it's all going up nationwide, and that is um, making it is putting pressure on the affordability of housing on top of interest rates and on top of real estate taxes or property taxes. So it is a challenge, and so far there's not a great solution. I know California has tried to cap some of the insurance costs, but all that's going to do is drive insurers out of the market, and I don't think that's going to work. One really interesting thing I learned is when we think of California as, there's a lot, high insurance costs, and we just think about the topic of disaster insurance, flood, fire, earthquake, etc. Um, and you look at sort of three regions of the country. If you look at the Southeast, and with its propensity for flooding and flood insurance, if you look at the Midwest for the escalation of tornadoes and tornado insurance coverage, and then you look at the West Coast for wildfires and the associated costs of that, the actual insurance cost as it relates to the cost of housing is actually much more expensive in the Midwest because housing there is much cheaper, but the insurance cost is disproportionately higher, which I thought, was an interesting sort of trivial tidbit. It doesn't make insurance more affordable in California, but it gives some context to the idea that it's really happening everywhere. So I think the idea here is that that insurance costs are going to be a growing sort of um, or a force in the calculation of home housing affordability. We've been sort of so focused on interest rates when really I think insurance is right up there with a cost, and I'm not so sure how that's going to play out. But I know that there have been, like in Florida, they set up a reserve fund for that too against hurricanes, which I think kind of worked in the last couple of storms they had in terms of the recovery. maybe there's something with that can be done with wildfires in California. I'm not quite sure.
And then one last question, and let me just remind everybody, I think our chat is now working, so you can feel free to put your question in chat or just go ahead and use the question and answer. That seems to be working very well. And we do apologize for some of the sound issues that we're having. It sounds like to be an internet connection, Jonathan, that I think we're having with on your side, but I don't want to stop the webinar. We may
Okay.
at the point ask you to turn off your video so that the clarity comes through. But I think if everybody's okay, if I don't hear from anybody else saying they prefer that method of turning off your video, let's hang on for now. So I got another question from Pablo. Can you explain in more layman's term why did the conversation change to being more complex when trying to explain when rates drop, sales increase? Why is that not happening?
Sure. Pablo's question is fantastic because that's why consumers are very confused. It's like, hey, the Fed does a big cut and mortgage rates rise. What's going on? I actually kind of wrote about this sort of in layman's terms. Um, as we got close to the election, which would be October, the month before, we uh, we started to see in the prediction markets, we started to see rising. Uh, uh, the polls are rising disproportionately towards the Trump administration, and that came with the economic policies that were more inflationary than the Harris policies, and that's why rates went in the other direction, I believe. And the reason why I think that's going to continue is because tariffs are highly inflationary. I mean, it's pretty basic economic concept. If you add costs to all imports, the consumer is going to have to pay more for goods and services. And I think, I'm not being political. I'm just, sort of, just saying that higher inflationary costs are probably why our concerns about it are why we're not seeing mortgage rate fall. The Fed, cut 25 basis points in their last meeting last week, and maybe it's not coincidence that mortgage rates sort of stayed level this week instead of rising like they have been since mid-September. So maybe it is having some impact. Obviously, when rates fall, that we see an increase in mortgage applications, we see an increase in sales. We still are seeing an increase in sales, but modest at best, even though rates have been rising.
Um, that's okay. One question came in. I got a couple others on chat. What
Sure.
type of government lands could be developed for housing in the new administration being considered?
Um, I honestly don't know that. I do know that both administrations, when they came in, and just sort of the basic laws of supply and demand is enable more housing development. Um, I think one of the biggest challenges of housing development today is creating affordable housing development. And when I use the word affordable is translated into middle class housing, modest, reasonably priced housing. And the problem today is that land prices are still very elevated, just as a general rule, which makes it difficult. So I think it's in every municipality's best interest to come up with housing initiatives so that their employees, the people that work in those cities, can actually afford to live there. I live in Connecticut, and I live on right next, or I used to. I just moved, but I used to live right near the Long Island Sound, and when you go inland, the elevation is much higher, and we would have snow days where schools would have to be closed because all the teachers couldn't afford to live where where our town was, and they lived further up in the hills, and they had snowstorms or blizzards, and we didn't. So there's a lot of distortion that comes out of this challenge. I'm
Awesome.
not really answering the question because I don't know the answer, but I do agree. I hope there's a lot of housing initiatives that um, solve the supply issue on top of the sort of where in the price spectrum they're located. Municipalities can't sort of subsidize all this. They don't have the money to do that.
Hey, Jonathan, I know I interrupted you and I want to give you time to finish, but we're getting a lot of questions, so I don't know how you.
Please go ahead. Please go
Okay.
ahead with the question. This
All
is good
right.
stuff.
And again, to everybody, please ask your questions. Jonathan is going to be with us for, a little bit, a little bit more time. So we'll just go with questions because I think that's going to be more relevant to our
Sure.
audience, right? So
Absolutely.
here's another question. What impact does the BRBC have on the market?
I don't know what the BRBC is.
Yeah. So okay. And we got others. All right, so I'm going to come to that. I'm going to come back to that one. Uh,
Sure.
all right. Here's another question from Gary. How is that inventory is suddenly a problem? As analysts have been saying, we have been underbuilding since 2009, yet prices increased 30 to 40% in some markets since the pandemic and have
Yep.
not come down. So further, since incomes have not kept up, how are prices still supported at these higher levels?
Yeah, so that's a really good question, and that's part of the confusion. So if you think about what happened during the pandemic, in 2020, the Fed kept rates too low for too long. The inventory of concern is existing inventory, existing supply, which is 90% of inventory across most housing markets in Manhattan, in the suburbs, in the housing markets I cover. Maybe 85% of inventory can be existing, but usually it's around 90%. So think about this. 90% of the housing supply was essentially was obliterated during the pandemic. I'm not saying it's 100%. There was zero, but literally that's what was sold off because rates were kept too low for too long. If you think about it right now, if you tripled new construction, that's still only 30%, 10% as a norm, and you tripled it, you're still going to have inadequate inventory for two reasons. One is because it's only 30% of the market if you tripled. And secondly, new development or new construction tends to skew to the upper half of sort of the income spectrum and doesn't even address the lower half of the sort of housing spectrum. So that's why I think the inventory is the most important and meaningful word or metric in housing today. And secondly, because I think that we're going to be playing around with a lack of inventory for the next 5, 7 years. This is not something that get fixed tomorrow. It's a slow motion phenomenon.
Okay, let's come back to the BRBC because it's new. It's new, so it's a new acronym. But the question is, what is the impact of the buyer representation broker agreement that was mandated by the realtors? So
Oh, are you talking about like clear cooperation or remember, I'm not a broker, I'm a market analyst, but recent discussion about clear cooperation or the NAR settlement and what that means with the buyer commission, the buyer agent commission. I probably should stay away from that because I'm not an expert in that.
okay, I think
Um,
that's a fair answer.
Yeah.
And maybe we'll try and
I
get.
mean, I understand what, that it happened in August, in the middle of August, and the buyer's commission now is not an automatic 50% of, the seller, and who's paying what. And I do think nationally there's a lot of confusion. I actually wrote a little bit about this in my newsletter that came out yesterday, just as a short plug for this. I write usually about 3 thought pieces a week, free. It's easy to sign up. It's at my website called housingnotes.com. And you'll see what I wrote yesterday, and that might help answer some of your questions on this topic. And I've written about it in the past as well.
All right. Hey, thank you. And another question from Pamela. Doesn't the 10-year bond more directly impact the mortgage rates?
That's the theory. But uh, I I look at it as what's the future perception of risk, and the future perception of risk is more inflation, and so there's a concern, by the lending community about future downside risk. Um, that may go away. That may be reduced. In the once their administration gets going, I don't know. The fact is that it's an unknown, and we don't know. Other than I suspect that we don't think we're going to go into a recession. We there is a higher probability of higher interest rates in 2025. But that doesn't mean it's a guaranteed thing. It just means that the probability is a little bit higher than it was before. I'm not getting technical, but on this intentionally. But the idea here is that we're not expecting rates to plummet just because the Fed is cutting. It's just not happening.
Got it. If there are any more questions, please continue to post them in the chat. Well, here's a couple more. No, I do not have any more here. But in terms of your reflection on this, the real estate vision for 2025, in terms of California and so forth, how are you seeing? Are you seeing any tall tale signs of upcoming changes, or is it just where are we?
Well, so in a lot of the markets that I've covered, in the month of October, I did see a modest uptick in contract activity. And that's with the rise in rates, and that's coming sort of leading up to the election. So I think what's going to be a tell is at the end of November, at the end of this month, if we do see contracts sort of hold, I would be more encouraged about the outlook for 2025, in that the election did restrain demand a bit, as I had opened this presentation with. The reason why I think there's going to be a modest increase in activity next year is almost solely on the idea that people have been waiting a long time for rates to come down, and they're being they've been arguably the brokerage community, um, and market participants that are looking to buy or sell have been disappointed by the fact that that really doesn't seem as obvious as it did a couple of months ago. Um, the idea that people have been waiting 2.5 years for lower rates, and the idea is still out there that rates will probably be a little bit lower over the next couple of years, maybe means a refi out a year or two from now. Like, that's still a possibility. And to buy before prices go up further, because I do think prices are going to continue, in a broad sense, prices are going to continue to rise, at a very modest level. But we're not expecting a price correction at all. because of inventory. And so that sort of shapes the way I think about 2025. It's going to be a little bit better than 2024. 24 was a little bit better than 23, just in sort of a general transactional level. The one consistent thing is that prices are probably going to continue to rise, but at a lower rate than they rose this year. And I think that's the prognosis. When we look at sort of the state of California in general as a market, we saw about a 12-13% increase in sales year over year to date in the state. I think that's encouraging. A lot of it has come in the second half of the year, so I'm encouraged that maybe will translate into more activity in 2025. It's just not going to be. I just am not a believer that it's going to be some sort of housing boom, or that rates are not going to drop in a significant way over the coming quarters.
So I have another question, statement, rhetorical, but I'm going to share it with you. It's from Alvin, and it's in regards to the biorepresentation contract, right? That was instituted in August and early September. But the question is more about how did that affect, say, your market, say the New York market?
Sure.
Here in what Alvin's saying, it slowed like crazy in August and early September for agents. And he thinks they were scared and didn't know what to do. So there was this pause. Was that something you felt not only in your market, but maybe around the country when these new rules, laws came in? Or
No,
no?
no, no. And this is, first, I'll give a bad example first. Is that in the New York metro area, since July, every month, and this is, so we're going on what, 4 months, July, August, September, October. Contracts in Manhattan year over year are up. Every month have been up about 30% from last year. And Brooklyn, a big market here in New York, up about 50%. So we've seen a lot, but all that does is bring the market back to the long-term norm parity. That sales were really low here and came back. Other areas that I covered, like Florida, contract activity did not plummet in August or September. Um, um, you know, uh, I'm not seeing that in Southern California. I didn't see that. Um, so I'm not sure what that is. Maybe that's a local idiosyncrasy. But there is some logic. I would think that sales activity probably was a bit restrained in the sense that brokers were confused. I mean, there's just been widespread confusion about how this is going to look when the sort of the dust settles on all the litigation and settlements and everything. But I don't think I would characterize this as the market stopping or pausing because of the broker transactions. I find the brokerage community to be a pretty resourceful bunch and aren't going to hold up a deal for 2 or 3 months because they're not clear about how the commission works. There's been a lot of good information that's been put out there by the brokerage community, and people are sort of tiptoeing through it right now.
So I have a question from Michelle, and she says, I'm seeing the big swing in prices has to do with the condition of the property. Fully updated are seeing increased prices, whereas dated homes are getting beat up on price. Do you see that overall?
Oh yeah, that there's a premium for finished space, or finished, move-in condition, or whatever the local sort of terminology is. This idea that finished is a bigger premium than normal over something that needs work. Part of that is probably some residue from the the supply chain shortage that we went through a few years ago. In early 22, when I was selling my home in Connecticut, it took me like 2 months to replace 8 sliding glass doors, and 7 of them came and one was broken. And then it was like another month, and I'm trying to sell my house and I can't because I've got, windows open to the elements. Uh, there's still some of that around, nowhere near like what it was. So I just think there is a premium on, we're seeing it in our appraisals in New York, a bigger premium for finished space than we typically tend to see.
All right, I know I have a bunch of questions coming in, so I'm just going to just fire away at you.
Yeah, yeah, go ahead.
And we are willing to stay after 11. I know we're coming to that hour of what we
I have
said.
a I have a 5 hour cap on, I run out of things to say after
Okay.
about 5 hours, so it's all good.
All right, good, 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 good. So thank you all for being with us. And here's the next question. Do you think that investors, especially foreign investors, have had an impact in the price inventory and driven prices up so that lower income homeowners are no longer able to afford a home?
Well, so when you look at, and certainly international demand in California is a significant force in the market. In New York, it's a big force in the market. But here's the problem with that concept is that the dollar has been exceptionally strong for the last 5 years, 6 years. And so what that does is remove the currency play, come here and, because there's such a difference in, what the dollar buys you now, it buys you less. The currency is so strong, and with more, potential for a tax cut, with more debt, in the country, or as a country, that also makes the dollar stronger. So I don't know if I would characterize international demand. Certainly, there's a component of international demand is, competing with domestic purchasers, and is, perhaps playing a role in certain subsets of the market and reducing affordability. But I think if we were talking about like 2006 or 2007, during that period where the dollar was a lot weaker, it would be, night and day. There'd be a dramatically bigger presence in international demand in California that is not happening now.
Okay. Here's another question from Liliana. Here in California, the market has slowed down. Not too many buyers jumping to buy a house. I know you maybe
Well,
touched
this
upon
is
that.
not unique to California. This is the national condition. Is Originally, the slowdown in sales was because inventory was so limited, but rising mortgage rates over the last 2.5 years have reduced affordability, which has restrained sales activity as well. And the only way for mortgage, in my mind, the only way for a dramatic increase in supply to come in is if mortgage rates plummet. I mean, like, go to the floor, really, we go back to 3 or 4% mortgages, where inventory really would come in. That's the only way I can see a huge amount of existing inventory. I'm not talking about new construction, which is only 10% of the, of total supply. If you had a collapse in mortgage rates, some deep, dark economic period, then I think you'd see a lot more supply come in. But that seems very unlikely. Economy is stubbornly strong.
Okay. And then I have another question here from another person named Anonymous. Thoughts on luxury market and tiny homes in the new year? That used to be a craze, right? One,
Right. Yeah. So do you mean, is that two different subsets, luxury market and then tiny
yeah,
homes?
I think, I mean, you're
Because
both spectrums of the
because
market, right?
because if you want to talk about a tight niche, luxury tiny homes would be like the tightest niche of the market I could think of.
No. There's an and between luxury
Got it.
market and tiny homes.
Got it. Got
Yeah.
it. So in terms of luxury, I think that luxury or higher end transactions are probably going to have a better year than the overall market. Um, and the reason why I think that is the propensity to pay cash as a workaround for luxury. In all the research that we push out, we just define luxury as the top 10% of all the transactions. So, like, for example, in Manhattan, the luxury market starts at $4 million. And so, transactions above that, and then in other markets, like in Fort Lauderdale, Florida, I cover, the top 10%, starts at like 800,000. So it all depends on your location, but I do think that we've seen an unprecedented use of cash as a bypass around high mortgage rates. In some markets, like in Southern Cal, cash buyers are about 60 to 65% of the purchasers. Um, um, they're and arguably those are higher housing prices than the Sacramento region, and just as a general broad sort of brushstroke approach. But the higher the prices, the higher the share of cash buyers, and it's just a way to bypass mortgage rates and figure maybe they can refi out or do an equity drawdown, pull funds out of the financial markets because the stock market has been relatively robust. Tiny homes, I don't know. Uh, with the proliferation of ADUs in California, sort of leading the nation in ADU adoption. There's been attempts everywhere, even in New York, but it's not been successful. I wouldn't be surprised if there's still, going to be an ongoing demand for tiny homes. I have to watch myself because in Manhattan, we've got studio apartments that are the smallest studio I've ever been in as an appraiser was 130 square feet, and it was on the sixth floor of a walk-up building. Um, Not my sort of idea of an apartment I'd love to have, but the idea is that sort of tiny spaces or tiny living is just a regular thing in our market. I wouldn't be surprised that this continues to be a niche that sees activity in California.
Great. I have another question here from Maria, and she wants to know if you can talk more about the affordability index forecast for 2025.
You mean what NAR puts out? I mean,
I
just
should
as
say
a
overall,
oh, right. So think about affordability is probably not going to improve in 2025. We have rates. It really is dependent on whether rates actually fall or not. I would think they're probably going to ultimately fall a little bit, but nowhere near what they were expected to fall because of sort of the forward-looking, economic policies. Maybe I'm wrong. I would think insurance costs are going to rise until the state figures out um, how to rein in costs without chasing out insurance carriers. Um, I would think real estate taxes are probably. I don't think there's anybody that would disagree with me that real estate taxes or taxes in general never go down. It's just whether they go up with inflation. And right now, I would think that the cost of homeownership is probably going to be somewhat higher next year than this year. The reason I think there's going to be a little bit more sales activity is just because of the 2.5 year wait that many consumers have had to endure and their life has changed during this period, and they can't wait anymore.
So we're going to end on this question, and then if everybody sticks around so we can do our thank yous. But I do want to thank you, Jonathan, and I'll bring Ben on and he'll do the close. But in terms of the new housing, will there be a new housing boom in 2025?
No, I don't think so. I'd love to. Yeah, it's an appraisal firm. I'd love to, see that happen. I'd love to, have people, more people get into housing. I think it's a little premature. If we had this conversation 2 months ago with the idea that mortgage rates were going to drop below 6% on a 30-year conventional fixed mortgage, I would say there was a distinct possibility of a boom. Instead of using the word boom, I would use, to be more nuanced, I would use uptick or expansion of sales. More sales, just not, a surge or a boom. I think would be more reasonable, an expectation. I hope I'm wrong, but I do think it's still going to be a better market in terms of transactions, just not dramatically better than we had this year.
Great. I'm going to bring Ben and myself back on. That will conclude our webinar. Ben, I'm going to turn it over to you.
Okay, Jonathan, that was great. It's the kind of thing that we love to put on for people who just kind of want to get a feel of what's going on. And I think you were spot on. And I thank you so much and look forward to seeing you in the future. So,
Oh, absolutely.
that was great. It was just, and I thank everybody for watching today. I hope you got some value and information out of that. I certainly did. So thank you all very much, and have a good day.